Welcome back to AlgoBot, your home for clear, educational breakdowns of automated trading strategies for MetaTrader 5. I'm your host here at AlgoBot, and in today's video we're exploring an expert advisor called Vwap band Fvg Reversion Hedge. This is a pure price action approach that builds its own volume-weighted average price, known as Vwap, along with deviation bands around it, and then looks for mean reversion setups confirmed by candlestick patterns and fair value gaps. By the end of this video, you'll understand how it reads the market, how it manages a protective hedge, and how the logic looks inside the actual code. Let's get started. Let's start with the big picture. The Vwap band Fvg Reversion Hedge is a mean reversion strategy, which means it's built around the idea that price often stretches away from a fair value and then rotates back toward it. The fair value here is the session Vwap, the volume-weighted average price, and the strategy computes this entirely from raw price and volume. There are no library indicators involved. At the start of each calendar day, the Vwap is re-anchored, and as new bars complete, a volume-weighted standard deviation builds dynamic upper and lower bands around that average. When price pushes out to one of those bands and then snaps back with a momentum reversal candle, the strategy interprets that as a possible exhaustion of the move. But it doesn't act on the band alone. It also wants confluence, meaning a second piece of evidence, in the form of a fair value gap or a tagged support or resistance level. Only when those pieces line up does it consider fading the move back toward the mean. This approach can be applied to liquid instruments like major currency pairs, indices, or metals, on whatever single time frame the trader attaches it to. Because it anchors to the calendar day, it tends to suit intraday time frames where a daily Vwap carries meaning. It's the kind of logic that appeals to traders who like structure and statistical context rather than chasing momentum. The strategy also has a defensive feature built in. Sometimes a stretch to a band isn't exhaustion at all. It's the beginning of a strong trend day. To handle that case, the expert advisor can open an opposite hedge position that targets a continuation move, while the original fade is closed for a small, controlled loss. This is all about managing the times when the mean reversion idea simply doesn't play out. As always, remember that trading involves risk, losses do happen, and everything we cover here is for educational purposes only, not financial advice. Now let's walk through exactly how the strategy makes its decisions. The expert advisor works on completed bars only, acting once per closed candle. Each new bar updates the running Vwap, and once the session has enough bars behind it, a minimum that defaults to 8, the calculations begin. The strategy measures the volume-weighted standard deviation, multiplies it by the BandSigma parameter, which defaults to 2, and places an upper band and a lower band at that distance from Vwap. For a long setup, several conditions must all be satisfied. First, the most recent closed candle must have stretched down so that its low pierces the lower band. Second, there must be a bullish reversal candle, either a bullish engulfing pattern backed by momentum or a pin candle with a long lower wick. The momentum check requires the candle body to be a meaningful fraction of the recent average range. Third, the strategy wants confluence, so it needs either a bullish fair value gap, which is a 3-bar imbalance where the recent low sits above the high from 3 bars back, or it needs the candle to tag a prior support level within the look-back window. Finally, the candle must close back up inside the band, showing rejection rather than acceptance. When all of that aligns, the strategy signals a buy. The short setup is the mirror image. The high pierces the upper band, a bearish engulfing or pin candle forms. There is either a bearish fair value gap or a tagged resistance level, and the candle closes back down inside the band. When those align, the strategy signals a sell. For exits, the take profit is placed right at Vwap, the statistical mean the strategy expects price to rotate back toward. The stop loss is set just beyond the relevant swing, the low for a long or the high for a short, with an additional buffer based on the average range. Before any order is placed, a minimum target filter checks that Vwap is far enough away to be worth the trade. Then there is the hedge. If a base trade is live and price keeps closing well beyond the entry band, by more than the hedge trigger distance, the strategy reads that as a trend day rather than a rotation. It opens an opposite position, sized by the hedge multiplier, that targets a continuation move, while the original fade is left to close at its stop. This is how the strategy attempts to recover when the mean reversion idea doesn't hold. Let's look at the actual MQL5 code, the way it appears in MetaEditor. At the top, you can see the key input parameters. BandSigma, set to 2, controls how wide the deviation bands sit around Vwap. The hedge trigger and hedge multiplier govern the protective hedge. The minimum body range fraction defines what counts as a momentum candle, and the minimum target multiple sets how far Vwap must be before a trade is worth taking. Range lookback and session minimum bars control the structure window and how long the strategy waits into each session. Now look at the long block. The variable long signal combines 4 things with logical and price stretch to the lower band, a bullish reversal candle, either a bullish fair value gap or nearby support, and a close backup inside the band. When that's all true, the code reads the ask price, sets the take profit equal to Vwap, and sets the stop loss below the lower of the recent low and the prior swing low, minus a buffer. Only if Vwap is far enough away and the stop sits below entry does trade. By place the order. The short block is the exact mirror. The variable short signal needs the high to stretch to the upper band, a bearish reversal candle, a bearish fair value gap or resistance, and a close back down inside the band. The take profit is again Vwap. The stop loss sits above the swing high plus a buffer, and trade.sell places the order once the same distance checks pass. Both sides aim back toward the same mean. Let's bring this strategy to life on the chart. Across the middle, you can see the gold Vwap line, the strategy's fair value for the day, with the blue upper band and lower band drawn at 2 standard deviations on either side. These bands are the boundaries the strategy watches for stretched price. Look at the first few candles. Price opens near Vwap and then drifts steadily lower, each candle closing beneath the last as sellers press the market down toward the lower band. By the third and fourth candles, price has traveled a long way from the mean and is pushing right into that lower blue band. This is the stretch the strategy is waiting for. On its own, though, a stretch is not enough. Now watch the fourth candle closely. It dips below the lower band, but then sellers lose their grip. A long lower wick forms as buyers step in and drive the close backup inside the band. This is the bullish pin rejection the strategy looks for, and notice that this low is also tagging the prior support from the look-back window, giving the confluence the logic requires. The reversal candle has formed, it closed back inside the band, and support is confirmed. The buy entry marker appears on the following candle as the strategy fades the move back toward the mean. From there, price begins to rotate. The 6th and 7th candles climb steadily, and as price reaches the gold Vwap line, the take profit marker is hit. The long trade closes exactly where the strategy expected the rotation to complete, right at the statistical mean. Notice how the whole idea hangs together. Price stretched too far, rejected, and reverted. But momentum doesn't stop at Vwap. Price keeps pushing higher through the 8th and 9th candles, climbing toward the upper band on the other side. Now the strategy is hunting for the opposite setup. On the 10th candle, price stretches up and pierces the upper band, but watch the top of that candle. A long upper wick forms as buyers fail to hold the highs, and the candle closes back down inside the band. That's the bearish pin rejection, and because this high is tagging the prior resistance from the look-back window, the confluence condition is met once again. The reversal is confirmed. The sell entry marker then appears on the next candle as the strategy fades the upper stretch, aiming back toward Vwap. The 12th and 13th candles roll over and decline, and as price returns to the gold Vwap line, the second take profit marker is reached. The short trade closes at the mean, mirroring the long trade we saw earlier. So in this illustration, you've seen the complete cycle on both sides. A stretch to the lower band, a bullish rejection with support confluence, a buy that runs to Vwap, and then a stretch to the upper band, a bearish rejection with resistance confluence, and a sell that also runs to Vwap. Notice what's missing in any setup that fails to qualify. If price had simply closed beyond a band without a reversal candle, or without a fair value gap or a tag level, the strategy would have stood aside. And if a fade had failed, with price closing well beyond the entry band, That's where the protective hedge would step in to chase the continuation instead. Of course, real markets don't always rotate so cleanly. Losses are a normal part of trading, and this walkthrough is purely educational. That brings us to the end of our look at the Vwap band Fvg Reversion Hedge Expert Advisor. We covered how it builds a session-anchored VWAP with volume-weighted deviation bands, how it fades stretch price back toward the mean using candlestick reversals confirmed by fair value gaps and support or resistance, and how it sets its take profit at VWAP and its stop beyond the swing. We also saw how the protective hedge steps in when a fade fails into a trend day, and we walked through the core code for both the long and the short side. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with the strategy you'd like us to examine next. You can find more educational content over at www.algobot.live. Remember, everything here is educational information only and not financial advice. Past performance does not guarantee future results. Trade responsibly.